Buongiorno a tutti. I am Paolo Sironi, your host of the Banker's Bookshelf, a new Breaking Banks Europe podcast that broadcasts from the heart of the Breaking Banks podcast family, the most followed fintech podcast in the world. The Banker's Bookshelf is our collective moment of critical thinking, inspired by authors and researchers of the most interesting books, papers, and publications which are finding their space in the libraries of curious bankers and fintech entrepreneurs. In each episode, I invite authors and researchers to share views that challenge the status quo and common assumptions in financial services. They challenge business culture and technology expectations to help us understand the banking present and its fintech future. With that, we can all make better informed business decisions. With that, I also want to introduce you to our guest for our episode number 2 of the Banker's Bookshelf. First of all, Mario Nava, Director General for the DG Reform. The Directorate General for Structural Reform Support helps EU countries to design and implement reforms as part of their efforts to support job creation and sustainable growth. Mario, welcome to the Banker's Bookshelf.
Many thanks. Buongiorno a tutti, and thank you.
And we also have Thorsten Beck. He is director at the Florence School of Banking at the Florence School of Banking and Finance at the European University Institute. The EUI was founded in 1972 by the 6 original members of the European communities and has earned a reputation as a transnational hub for research and higher learning. The EU Supervisory Digital Finance Academy is a flagship initiative of the EUI and the Florence School of Banking, supporting financial supervisory authorities in coping with the risks and opportunities associated with the use of advanced technologies in the financial sector. Thorsten, welcome to the Banker's Bookshelf.
Thank you for having me.
So then, why do we have Mario and Thorsten today on the Breaking Banks Europe podcast family? Because the European Commission has established the EU Supervisory Digital Finance Academy in collaboration with the European University Institute and the 3 European supervisory authorities, the EBA, ESMA, and the EIOPA. The EU-SFDA encompasses comprehensive training cycles and workshops, enabling the acquisition of new expertise and skills, knowledge sharing, and peer-to-peer exchanges within the financial supervisory community. And I'm honored. I was invited to contribute to the opening of the academic program and share content of my latest bestseller, Banks and Fintech on Platform Economies, Contextual and Conscious Banking. Now, as part of this academic initiative, the EUI has published a collection of research papers titled Digital Finance in the EU, Drivers, Risks, and Opportunities. It contains contributions of some of the main topics covered in the training activities of the first year of the Academy, or other activities and workshops hosted by the EUI and the European supervisory authorities. Now, to me, this research publication, which I read with extreme interest, has the merit to be, at the same time, deep in knowledge sharing, but also easy in comprehension. A must read for the audience of Breaking Banks Europe, as we all look at the present and future of financial services in the European Union and certainly beyond. Now, let me ask Mario, first of all, as this initiative, this research activities is part of an initiative sponsored by the European Commission. What is the EU digital finance strategy and where does this sit at the heart of this strategy?
Well, good morning, everybody, again. First of all, obviously, the digital finance has completely changed the way in which citizens use money. And when I say use, it means it has changed the way through which citizens pay, through which citizens borrow, and through which citizens invest their own money. Digital finance is not only about the use of money, but is about the whole set of data which is being collected. And data means personalizations. And the personalizations can only come through the, let's say, additional facilities which are offered by the digitalization. So there is a whole string of consequences that comes from an increased use of digitalization and intelligence, both artificial and human intelligence. The digital finance strategy has 4 main priorities. One is remove fragmentation of the single market. 2, adapt to the EU regulatory framework to facilitate digital innovation. 3, promote data-driven innovation, which with that brings the question of how you keep and store and use data. And 4, address the challenges and the risk associated with the digital transformation. So it's a vast program, obviously, which is spurred by the opportunities that are offered by the digitalization. But with that also, we need to make sure that everything is in place. Let me give you a very personal example. 6 months ago, one of my daughters told me, I'm unhappy with my bank account. I want to find another one. I said, great, go to Place du Monde, which is a square close to where we live. And she looked at me as if I come from another century. And she says, Place du Monde, I go here. And she went on the telephone. And then she ended up subscribing to a very famous Lithuanian bank. So that's what digitalization is.
Okay, well understood. Now, Mario, I understand that the European Commission has promoted this supervisory academy together with the European University Institute. How was this project born?
The project was born, first of all, I would say it started from an obvious request of member states. Member states wanted, felt the need, on the one hand, not to stifle the innovation that came from digitalization, not to stifle the opportunities that comes from the possibility of having better and better suited products for the clients on the one hand, but on the other hand, I think a very honest recognition that there was a need for an academy to boost their knowledge. So we put the two things together and we discussed to a few people, and actually Thorsten was one of the very main actors. And we came up with the idea of the academy, which is called academy and not school, exactly because what we want to do in this academy is to put people together, is to put knowledge together. And we started with a group of member states, I think something like 14, 15. And then progressively the member states increased. And today we have 26 member states, nearly all, and something like 37, 38 national competent authorities. That means several member states send both competent authorities, so let's say in Italy, Banca d'Italia and Consob, and the equivalent in all other countries to this academy. Till today, we have trained through the academy about 1,000 people, which is quite formidable in the first 3 years.
It's absolutely formidable. I'd say that I travel the world continuously in my professional role, and I meet regulators, bankers, fintech, and I have to say that this is kind of a unique and peculiar initiative that is worth looking at from everywhere in the world. And now, Thorsten, as you basically work and build the program, tell us about your perspective and experience with the research in the EU Supervisory Digital Finance Academy.
So we were founded, the Florence School of Banking and Finance was founded as to be a bridge between practice, policy, and academia. And I think the SDFA, the Supervisory Digital Finance Academy, really kind of personifies this kind of approach. So the focus is, of course, on the supervisors, on the supervisory authorities, to learn, to exchange, and to build a community. I think that's one of the most important issues, because what we've also seen during the meetings, during the trainings and the workshops, that supervisors come sometimes from neighboring countries and they find out, oh, you have similar issues. Oh, you have a similar challenge. Oh, you're working on a similar solution. Why don't we get together? So from our viewpoint, actually, when we will look back at some point in the future and say, well, was it a success? Yes, there will be KPIs, like Mario mentioned, the number of trained staff, the number of workshops, the number of publications, the number of videos that we've filmed, and so on. But I think the much more intangible outcome will be the building of a community of supervisors in digital finance. The community that can exchange views also as we go along. Because, as we're going to discuss in a moment, this world of digital finance is moving so quickly. I mean, what we teach in this first round might not be relevant anymore in 1 or 2 years. So things are changing along. And again, the community aspect is a very important one. The other important element, which Mario already alluded to, is this cross-sectoral element. So we have banking, security markets, and insurance and pension regulators, which we also do again with the support of the three SRs for banking, security markets, and insurance and occupational pension in Europe. So I think that together really makes the SDFA a very special project. And maybe two more points I would like to get to is one is I mentioned this bridge between policy, academia, and practice. So we also bring in the industry, payment service providers, fintech companies, so they can, so the supervisors can learn about the latest developments, can learn about the perspective from the industry, and also the other way around. So again, it's community building, but also dialogue, which ultimately is very important. And then the ultimate aspect, it is, yes, it is an EU initiative. It's a European initiative. But of course, we also bring in, for example, speakers from outside. We speak speakers from Singapore, from Switzerland, from the US, to get alternative perspectives. And I think, again, it's a two-way street. They also learn from our perspective. And again, with a community that exchanges within Europe, I think we can also foster both our standing as the European Union in digital finance, but also foster the global dialogue.
So Thorsten, you said something very important to me that resonates well. So you're bringing together the securities market authorities, the banking and insurance authorities. Now, the authorities has been shaped around an industry that was divided in different pillars according to the products, but the client is always one. Now, I'm announcing to our audience that our next episode will provide an anthropological perspective of client centricity beyond the products and beyond technology. And when it comes to technology, our anthropology seems to be challenged these days by artificial intelligence, the latest and greatest news around generative AI. So the European Parliament has just approved the Artificial Intelligence Act that ensures safety and compliance with fundamental rights while boosting innovation. Therefore, before we deep dive into the content of the digital finance in the EU research paper, I would like to ask Mario Nava, how does this differ from other jurisdictions, and explain why this is important for EU citizens, businesses, and tech companies?
I think you introduced the subject extremely well. I mean, the crucial issue is the client centricity. And the client is a client, and the client may at some point in his life be more interested in investment because, for example, he is working as a stable worker, but then maybe becomes a self-employed, so he may be interested in some insurance product. So the center, putting the client at the center is essential. Putting the client at the center means making more and more personable the products, and artificial intelligence is a phenomenal tool to do that. But we need to do that in a way that is trustworthy. So the idea of the EU Artificial Intelligence Act is, I would say, an incredibly simple idea, is the one of foster trustworthy artificial intelligence in Europe and beyond by making sure that the artificial intelligence respects the same rights, the same safety, the same ethical principle, and the same risks that a normal intelligence, that an employee at the bank or at the insurance booth would respect. This, of course, is the basic idea, but then this idea needs to be developed in a rather complex framework. So first of all, we need to make sure that we enhance governance and enforcement of the existing law on the fundamental rights and safety requirements that are around the area of artificial intelligence. And second, we need to introduce very clear obligations or requirements for the artificial intelligence systems, which are powerful, but with that brings higher risks of essentially misuse. So it's a sort of an equilibrium that we are trying to find between the two. There is no interest for anybody, and in particular, certainly not for the well-being of the European society, to limit the innovation and therefore to stifle artificial intelligence system. But there is obviously a legitimate demand and request from the population that understands maybe the potential of the instrument, but maybe equally a little bit afraid, if nothing else, by its novelty, by the fact that it's not been yet necessarily tried and tested. And therefore, this is why we have put these requirements. But in order for this requirement to work, and I link to what Thorsten explained extremely well, in order for this requirement to work, you need that the supervisors understand them, and they understand them very well. Otherwise, you have a law, and those that are supposed to enforce it, if they don't get it around, it's a bit of a void law.
Absolutely. Everyone needs to be involved at start. And now, having heard you talking about the balance between risk and search for value, in my latest research, Regenerate Banking with AI discussed this trade-off, like while businesses search for value, they need to care about the complexity of that implementation and the management of the risks. Now, in the 1990s, I was the head of quantitative risk management for financial institutions. And I remember quite a number of CEOs were saying that every banker must be a risk manager. Now, what I'm saying in this research is that every banker must be an AI risk manager. And with that, we deep dive into the content of this very interesting publication, The Digital Finance in the EU. And one of the papers that I've been reading that is part of this collection is written by Paolo Sironi, and it's titled Safe Artificial Intelligence and Machine Learning. So basically, the paper, in a sense, its course starts with a discussion around the risk management perspective. So, Thorsten, can you share with us the key findings of this paper inside this broader publication?
Yes, thank you. So this is basically about how can we evaluate the risk management of AI. Again, coming from the perspective that it can be very useful, but it also poses certain risks. So SAFE, SAFE stands for sustainability, accuracy, fairness, and explainability. Sustainability refers to, is it not just being used in one setting, but can it be easily transferred to other setting? And is it resilient to anomalous extreme events, or, for example, cyber attacks? That's the first one, sustainability. The accuracy is, how accurate is the prediction of the model? And again, comparing what the model predicts and the actual outcomes that we can observe in the data. Fairness, are there biases towards specific groups, towards specific population groups, towards specific minorities, for example, or people with certain characteristics? And of course, we would like to have the minimization or even absence of such biases. And then finally, explainability, which I actually personally, that brings us back to what you just said about the CEOs being AI expert, is can this output of the model, of such algorithm, of artificial intelligence algorithm, can it actually be understood and overseen by humans, and therefore then also assess the consequences of these, the output of the algorithm? So they started with these kind of four attributes that an algorithm should have: sustainable, accurate, fair, and explainable. And then also start developing certain metrics with which you can actually assess the risk management of a AI algorithm.
So now, technology in itself can be complex, and therefore we also need a framework to risk manage the complexity, sometimes the opacity of this technology, to make sure that we can use it with comfort, understanding what goes on. So the SAFE concept or framework is wanting to do that, the risk management of AI, focusing on sustainability, accuracy, fairness, and explainability. Now, talking complexity, something is also happening in financial markets or broader capital markets, which is the concept of DeFi, decentralized finance. And there is another piece of research titled Blockchain and DeFi, an economist perspective for supervisors, which I find extremely interesting. Because in the discussion of the various trade-offs between technology and this transformation of the underlying structure of the economy, financial markets, or the business models, the researcher discussed this concept of the blockchain trilemma that I think is really spot on. So, Thorsten, again, can you get the audience to understand this, at least in its essence? And I'm sure that everybody will want to download the paper, or links will be provided together with the podcast to really learn more about that.
So this DeFi, decentralized finance, basically was developed as an alternative to traditional finance. And if you think about traditional finance, it's really built on trust in certain central authorities. And again, you can think about this being the central bank, being a supervisor, but also being a clearing system or being the payment system. So we really typically, and that's where the intermediation function ultimately comes in, from these gatekeepers of the financial system operating critical infrastructure. Mm-hmm. Now, decentralized finance tries to substitute this, replace this trust in a central authority with consensus or decentralized trust. For example, through these build-up of blockchains where certain transactions have to be approved by everybody, but once they're approved, they are for sure. They cannot be reversed anymore. Now, this, as Thorsten Beck in his paper and also in other population has shown, comes at a cost. And this trilemma basically that he develops is about decentralization, scalability, and security. And you can only, as this goes with a trilemma, only achieve two of them. If you have decentralization and security, you can't really go for scalability because consensus is costly to achieve. So that's in a nutshell why the DeFi world hasn't really achieved what it set out to achieve. And what we actually seen in the last couple of years is actually, again, a centralization. So if you want to invest in crypto assets, cryptocurrencies, you typically would go to an exchange that actually is, again, replaces this consensus by actually kind of being an intermediary in the decentralized finance world. And at the same time, you have attempts from the decentralized finance world to link back into the traditional finance world, for example, through stablecoins. Stablecoins that kind of are backed by fiat money and are linked or pegged to fiat money. Now, this, of course, is on the one hand a development as we see it. On the other hand, of course, this can bring in fragility from the decentralized finance system, which is a very, very volatile segment of the financial system. You just have to look at the price of Bitcoin. This might bring fragility, volatility from the decentralized financial system back into the traditional financial system. So far, we've not seen much of it, but of course, it's really a space to observe. Let me just add on my own personal view is that there's a lot to be said about this technical innovation of blockchain. More, however, if they're actually intermediated or permissioned blockchain. So there's, again, somebody in the middle who actually takes this on. On the other hand, this completely decentralized financial system with crypto assets and cryptocurrencies so far seems to have contributed relatively little to societies, I would say. It doesn't really fund any real activity. And ultimately, it also comes, at least in the case of Bitcoin, at a very high environmental cost because there's the whole mining of Bitcoins that ultimately requires lots of computing power and lots of energy use.
So in essence, we need to go beyond the words. There might be a common narrative, which is very romantic about the decentralized finance. Romance is good in personal life. Being romantic in finance or technology is not good, but grounded. Now, the audience can imagine this trilemma as a triangle that at each corner has decentralization, scalability, and security. Now, if you're in the middle and you move on one side towards decentralization and scalability, you can go fast and broad, but you may miss out on security, which is not good. If you then move towards scalability and security, you might have to centralize a lot, which reduces opportunities to create a different type of perspectives. And if you want to be very decentralized but secure, you might reduce your capabilities to scale up, basically to be impactful. So it's a balanced approach that starts with your philosophy on how you look at the business, and it then is grounded on how you build it with technology. Now, decentralized finance, in essence, when we discuss decentralization to the extreme, brings up the complexity of the system, a kind of topic. Now, financial services are de facto complex environment. We touch so many aspects of the economy and personal life, and also the interaction among the intermediaries. And for regulators and central bankers, it's sometimes very difficult to understand the complexity of the system, and therefore the impact of their decision-making, the impact of policy changes or other external events that occur that would have anyway an impact on the internal transformation of, for example, the European economy. So there is another research piece inside this publication which discusses about a case study by the Dutch central bank on how artificial intelligence could be used to basically better understand the complexity of the financial system, as we learned through the global financial crisis, that not all connecting points were known or understood. So here again, Thorsten, what do you believe is the key message or element that the researchers are bringing to the forefront of the conversation?
So if we take a step back, it's 50, 60 years ago, what we as quantitative researchers could do is do correlations. And we would do them with paper and a pen. Then, of course, we had computers. We could start running regressions. Well, not everybody had a computer, but at least you could line up for a computer and then run some regressions. And ultimately, when I started out my PhD, you could actually start longer programs. So there was this famous paper that I just ran 1 million regressions. So that was a big thing. That was in the 90s. If you look back now, you would say, why just 1 million? And then the computing power has enormously developed, plus the availability of data has multiplied. I mean, I forgot the exact number, but I think 99% of all data in human history has been probably produced during the last 1 or 2 or 3 years, maybe. So how can we actually put this data to use without drowning in the enormous amount of data that is out there? And this is ultimately what this chapter describes, machine learning approaches that combine different data sources, in this case, primarily qualitative, but you can also use it for qualitative data, so meaning text analysis, natural language processing, and you can combine that for specific purposes. So there are a couple of examples, such as the better understand new sources of risks. Think about climate risk, for example, or also in the context of know your customer, KYC, and anti-money laundering, AML, to look at identify outliers in transaction patterns, for example. And are these transaction patterns completely innocent, these outliers completely innocent, or are there actually something more behind it? So it is ultimately putting lots of data with lots of computing power and trying to identify relationships that we typically 20 years ago, you would not be able to do with regression analysis, because they're not linear relationships, they're non-linear. And they're based on outliers, and they're based on relationships that change over time and across the different segments of the database. So that's in a nutshell what this machine learning approach tries to undertake. And ultimately, that takes us to what we sometimes also refer to as subtech. So the use of technology in supervision by supervisors to make it ultimately more effective.
So Thorsten is like revealing the network of the system, right? That is not always well understood. And that is important because the network can go under attack, which is the discussion around cybersecurity. In my IBM research for the Institute for Business Value, we've been asking 3,000 CEOs worldwide of all the industries about the key challenges for their organizations. And when focusing on the banking and financial market CEOs for the last few years, cyber risk was always the number one that they elected as the key challenge, followed by other elements like regulation and sustainability. Now, there's no doubt that while the world is unfortunately closing up a bit further, banking is opening up more and more due to open data, open banking, embedded finance. So cyber risk is a foundational element to make sure that all of this innovation is generated without creating unwanted consequences. So again, there is an interesting piece of research that discusses cyber risk in the financial sector by Emre Islam and Klaus Lober. So which is the key element that we are, if you like, highlighting in this piece of work by the EU Supervisory Digital Finance Academy?
So again, taking a step back, cyber risk is really a novel, but also an important risk. And we're still trying to figure out how to actually address it. I mean, for example, the European Systemic Risk Board has declared cyber risk one of the major risk factors faced by financial institutions and markets in Europe. And there is, if you think about what characterizes cyber risk, it's the speed, how quickly it can develop. It's the scale, so it's not just one institution that might be affected, but it can then go through the whole financial system, through the payment system, and basically put down the whole system. And of course, there is the threat element. So there's this the bad intent of criminal or political actors to ultimately undermine our financial system and thereby our economies and societies. Now, what can we do? What kind of tools can we do we have to develop to address that? And again, this is taking into account, this is a very different risk than the typical financial stability risk. So yes, capital buffers can be important, liquidity buffer, and so, but it's much more than that, because it's a different type of risk. And ultimately, it's about avoiding that the cyber risk and the operational risk that comes from it ultimately results in these more traditional financial stability risks. So what do we need? Well, number one, we need a clear strategy how to go about it. We need frameworks, regulatory supervisory frameworks. We need coordination across different types of authorities within a country, but also across countries. Because again, these cyber attacks, they don't stop at the border, and they don't stop at banks. They might swap over into insurance companies and other providers. We need to think about backup system, emergency plans, plan B, plan C, and recovery actions. How do we recover from such a cyber attack once it has happened? Again, coordination I mentioned, information sharing, best practices, threats, and I think also cooperation between the private and public sector is very important. And then maybe a final element, it is also kind of a deterrence. Deterrence ultimately through law enforcement, at least if it's in our jurisdiction. And I know that supervisors don't like to call the police, but sometimes in this case, it is very important to work together.
So everything has to start from a clear perspective on resilience and security. It's a shift left of the DevSecOps operations. And now all of this needs to become something real. So towards the end of today's episode, I still have a couple of topics that I want to discuss with you. One is really at the end of this digital finance in the EU research piece that is about business model analysis. Now, in my own literature, the Banks and Fintech Compatible Economies, I tried to respond to two questions of two esteemed central bankers, Alan Greenspan and Mario Draghi. Let me tell you the one of Mario Draghi. In 2019, 2 weeks before he left the European Central Bank for Ms. Lagarde, he was asked a question by a journalist if they say negative interest rates, now we can say complex macroeconomic conditions, would create the next collapse of the financial system, a resiliency problem. And Mario responded to the journalist. He said, of course, I know that bankers would love positive rates, right? And he develops his discussion and explanation talking about the cost-income ratio, which is way off from any average indicator, especially for European banks and so on and so forth. But in the end, he said something that to me is very important. And when central bankers talk, every word matters. He said they had to adjust the business model to the digitalization of financial services. So the question becomes, which are these business models? Now, I made my attempt in literature to explain, but the point is, how can all stakeholders that operate inside an ecosystem and in an organization understand that the board, the CEOs, the managers, and the supervisory authorities. So that's why I think that this latest chapter at the end of this paper is super important, the business model analysis.
Let's start with what do we mean actually by business model? So it's basically the means by which a financial institution generates value from its business. And it's the focus on the clientele, what kind of product, what kind of delivery channel, and how to link, transform liabilities into assets, or the other way around, how to combine assets and liabilities. Now, so it's a very old question. Of course, digitalization has affected it. But one thing we really have to keep in mind is that these business models can work for a long time, but are at the same time very fragile. And I guess the best example we saw last March, Silicon Valley Bank looked like a reasonably good business model with its clientele, startups, very unique, with the investment into government bonds because a lot of cash came in. And then we saw that it broke down basically within a couple of days, partly also in reaction to, of course, tightening interest rate. So business models, it's not just about business models per se, analyze them, how profitable are, but also how sustainable they are. Sustainable in certain extreme situations. And again, where does that digitalization come in? It creates new delivery channels through the phone, through internet. It might also create new clienteles, as we saw, for example, in SVB, or different clienteles. For example, we talk about, Mario mentioned his daughter. I have similar experience with my kids. The Generation Z, right? They have very different approaches to financial service provisions, to financial service consumption, if you want. And again, how financial institutions cater to them is, of course, very important. Now, it's not just about the business model of the individual institution, but also how do either traditional business models or digital business models that are being changed with digitalization, how do they react to competition? I mean, one thing that has often been mentioned is that these new providers, fintech, sometimes even big tech companies, are kind of chipping away at the intermediation chain, right? Because banks do offer a bundle of products. They offer deposit services, lending services, payment services, risk management services. And many of these new providers, they kind of chip away, take specific pieces out, which then might banks be less able to ultimately benefit from these scope economies across these different business lines, and ultimately might put under threat the business model. So I think again, business model analysis has been always important. I know it's important, for example, at the single supervisory mechanism in Frankfurt. And ultimately, if you think about business model, it is really important to say, is it profitable? Is it sustainable? And is it viable? And again, we've seen some cases in 23, partly it was really about the business model that was either not sustainable or it wasn't viable going forward. And that refers both to the failure we've seen in the US, but also in Switzerland. And ultimately, for supervisors, and I can say that because it's also been written in the book, this business model analysis is actually a critical part of the so-called supervisory review and evaluation process, the SREP, which is a critical component of what is being done in ECB, bank supervision, and international competent authorities.
So, Thorsten, I have to excuse myself with the authors of this ebook because we only shared 4 or 5 of their contribution. There's much more inside this one that we didn't have the time to share with the Bankers Bookshelf audience. And actually, there's so much more into the future of Europe and financial services that we still have to figure out. So to wrap up this episode, I would like to ask Mario Nava the perspective of the European Commission looking ahead in terms of what do you believe are the next steps, challenges, and opportunities that we will all have to work upon?
Well, first of all, let me say that warm invite to everybody to dive into the book and into the ebook if they really want to see what comes out from the experience we are doing, and even more, because the ebook only takes inspiration from the school, but then develops it a lot. So I'm really grateful to Thorsten and co-authors for doing that. Paolo, I see 3 priorities to conclude. Priority number 1, I think, is to make sure that everything we are talking about is properly implemented. So it's the implementation of the regulatory frame. We have been regulating a lot in the last few years. There is no doubt. Now we need to make sure that whatever has been regulated is properly implemented. 2, I need to emphasize what Thorsten said very clearly, which is that the knowledge that the supervisory authorities need to have is a dynamic one. What they learn today may be relevant for the next 2-3 years, may not be relevant in 5-6 years. So continue supporting the supervisory authorities' knowledge and efforts is essential, and is essential in a very dynamic way. And third, as you know very well, all our transformative policies, the green policy, the digital policy, have always a social aspect. We don't want to have a digital policy which leads to exclusion, which leads to divarication in the society. So there is always an element of inclusion for the least able, the least well-to-do, the least open to novelties that we want to have in every type of policy.
Ultimately, we don't do technology for the sake of technology. We do it for the benefit of all of us. Exactly. So I thank you for the time you dedicated to join the second episode of the Banker's Bookshelf. Mario Nava, Thorsten Beck, thank you very much indeed. Now I remind all of our audience that the Banker's Bookshelf is our collective moment of critical thinking, inspired by authors and researchers of the most interesting books, such as this ebook, papers and publications, which are finding their space in the libraries of curious bankers and fintech entrepreneurs. Thank you all for attending the Jingle Now.